All right, welcome back. Today we're diving into Class 5 of our Investment Basics series, and we are going to tackle two of the biggest ideas in all of finance: risk and return. Seriously, getting this right is the absolute key to building a successful financial future. So let's just jump right in with a huge question. Is investing just a fancy way of gambling, or is it a calculated, strategic plan? This is really the heart of what we're talking about today. And by the end of this, you'll know the answer. Oh, and definitely stick around because I've got a challenge question for you at the end to make sure you've got it all down. Okay, first things first. We have to understand the number one non-negotiable rule of the entire investing game. It's called the risk-return trade-off. So what do we even mean by risk? Well, in the investing world, it's simply the chance that you might lose some money or maybe just not make as much as you'd hoped. But here's the big secret. Risk isn't some evil thing you have to avoid. Think of it more like the fuel for a rocket. Without some risk, your investments just sit on the launch pad. They have no power to go anywhere. And on the other side of that coin, you've got the return. This is the reward. It's what you get for taking on that risk. Now, it usually shows up in one of two ways. Either as capital gains, that's when you sell an investment for more than you paid for it, or as income, like getting dividend checks from stocks or interest payments from bonds. Now check this out. This chart lays out that trade-off perfectly. Down at the bottom, you've got a savings account. Super safe, right? But the return? It's tiny. Then, move up a notch to government bonds. You're taking on a little more risk, and in exchange, you get a better potential return. And then you get to stocks. The potential for big returns is huge, but so is the risk. It's all about figuring out where you're comfortable on this spectrum. And this just says it all, doesn't it? Let that sink in for a second. This is the golden rule, the law of financial gravity. If you want a shot at higher returns, you have to be willing to accept higher risks. There's just no way around it. So, if we know risk is part of the deal, how in the world do we manage it without giving up all our potential gains? Well, that brings us to our next big topic. It's time to forge our financial armor with an incredibly powerful tool called diversification. But first, we need to get comfortable with a word that tends to freak people out: volatility. All this means is how much an investment's price bounces around, up and down. But for a long-term investor, those swings are just noise. Volatility is about uncertainty, sure, but it doesn't automatically mean danger. And this is why diversification is your absolute best friend. It's your shield against all that volatility. It's the age-old advice: don't put all your eggs in one basket. The real magic here is owning a mix of different things that don't all go up or down at the exact same time. So when one thing is zigging, another is zagging, and it helps smooth out the ride for you. This chart is a perfect picture of diversification in action. See? Instead of going all in on tech stocks, this portfolio is spread out. It's got a slice of healthcare, some safer bonds, some investments in other countries, and even a piece of real estate. So if the tech industry has a really bad year, the other parts of the portfolio are there to help pick up the slack. And here's exactly how you can do it. You can spread your money across different types of assets, like stocks and bonds. You can spread it across different industries, like tech and healthcare. And you can even spread it across different countries. The whole idea is to build a team of investments where they're not all having a good day or a bad day at the same time. The more layers of protection you have, the stronger that armor gets. Okay, so we've talked about the market and the tools, but honestly, the biggest risk in investing, it usually isn't out there in the world. It's right here inside our own heads. It's time to talk about the investor's hidden enemy: our emotions. You know, this quote might be the truest thing ever said about investing. The math part, it's pretty simple, but controlling your own psychology, that's the hard part. The two most destructive emotions for your portfolio are good old-fashioned fear and greed. And this slide just nails it, showing the two very different paths you can take. You've got the emotional investor, who gets all excited when the market is hot and buys high because of greed. Then, when things take a dip, they panic and sell low out of fear, which just locks in their losses. But the disciplined investor, they do the exact opposite. They have a plan. They stick to it. They stay calm. And they never lose sight of their long-term goals. And history proves this over and over again. I mean, think about the huge crashes we've seen, like the 2008 financial crisis or the big drop in 2020. At the time, they felt like the end of the world.
But the people who panicked and sold missed out on the incredible recoveries that came next, when the market shot up to brand new highs.
So let's get practical. How do we actually build a winning game plan? It all boils down to combining the right tools, like diversification, with the right mindset, which is all about discipline and patience. Every single investor needs a simple plan for managing risk. And it really just starts with 3 questions. 1, how long are you investing for? That's your time horizon. 2, how much of a drop can you handle without freaking out? That's your risk tolerance. And 3, based on those 2 answers, you decide on your asset allocation, your own personal mix of safer and riskier stuff. And please, never ever forget this. Your single most powerful tool for reducing risk is time. Yep, just time. The longer you invest, the less those daily ups and downs even matter. They just become noise. And it gives that incredible magic of compounding more room to work for you. And that brings us to the big mistakes that trip up so many new investors. We've actually talked about all of them. Not diversifying, making choices based on fear or greed, thinking you can perfectly predict the market's next move, and obsessing over every little price change. If you can just avoid these traps, you're already way ahead of the curve. All right, we have covered a ton of ground today. So let's do a super quick recap of the most important wisdom you've gained before we get to that final challenge I promised you. Okay, here are the 5 big ideas to remember. 1, risk and return are always linked. 2, market swings are totally normal, so don't panic. 3, diversification is your shield. 4, controlling your emotions is your secret weapon. And 5, maybe the most important of all, being in the market for a long time is way better than trying to perfectly time the market. All right, here we go. Your challenge question to prove you've mastered today's lesson. Let's say you have $10,000 to invest. You put half of it, that's $5,000, into stocks that you expect will return 10%. And you put the other half in bonds that you expect will return 4%. So what's the total expected return on your entire $10,000 portfolio for the year? Go ahead and pause, think it through. If you can crack this, you really truly get how to build a balanced portfolio. Let us know what you come up with in the comments.